Every week I sit across from very smart people, senior professionals, business owners, C-suite executives, people who have built real wealth over their careers. And many of them have already invested into a structured note, or they have been offered one by the bank. But when I ask them what actually happens to your money from the day you invest to the day you get it back, most of them cannot answer that question. And that is not their fault, because nobody has ever walked them through. The bank shows you just the headlines, 8% capital protected 6-year term, and then the conversation moves on. So today, that is exactly what we are going to do. We are going to take one real structured note issued by Goldman Sachs, and we are going to follow it from the very first day all the way to maturity. Every stage, every observation date, every possible outcome. And if you have never heard of a structured note before, that is completely fine. I will give you enough context along the way. But if you have been following this series from the beginning, today is where everything starts to click into place. Now, before we look at the mechanics, a quick but important note. Everything we discuss today is for educational purpose only. I'm using a real-world example to show you how these products work. But this is not a specific investment recommendation for you. Please consult with a qualified advisor and read the full disclaimer at the end of this video. Now, before we go any further, let me give you 30 seconds of context, just so we are all on the same page. A structured note is a financial product issued by major banks like Goldman Sachs, JP Morgan, UBS, Citibank. It falls under the category of a bond. What I mean to say is, you are lending your money to the bank, and in return, the bank gives you a defined promise, a specific return under specific conditions. And if you rip apart a structured note, you will find two things inside. One is a bond, that is what protects your capital. The other is a derivative, that is what creates your returns. The bond does the heavy lifting. The derivative is what generates the coupon. Now, the bank does not create these products as a favor to you. They create them because it serves their business. This is what videos 1 and 2 covered. If you want the full picture, I would recommend going back and watching those first. The links are in the description. So let me introduce you to someone. I want you to imagine a senior professional. Let's call him Rahul. He has been working in Dubai for 15 years, good income, disciplined saver. Over the last years, he has built up a reasonable amount of cash sitting in his bank account. But Rahul is not reckless with money. Quite the opposite. He is careful, he is conservative, and that is exactly why the stock market makes him nervous. He has watched colleagues lose money chasing returns. He does not want that. But at the same time, he looks at his savings account paying him 3, maybe 3.5%. And he knows that after inflation, he is barely breaking even. He wants income, real predictable income, without putting his capital at risk. Now, this is a very common situation, and this is exactly the kind of situation where a structured note can make a lot of sense. So Rahul comes to us, and after understanding his situation, his risk appetite, his timeline, his goals, we present him with a note issued by Goldman Sachs. Here are the key terms, and I want you to follow along carefully, because this is the note we are going to track for the rest of this video. The issuer is Goldman Sachs, one of the most recognized financial institutes in the world. Their credit rating, Moody's rate them A1, S&P rates them A+, Fitch rate them A+. I will come back to this, why this matters. The note is linked to 4 indices: the Swiss Market Index, the Italian Index, the Nikkei 225 from Japan, and the Russell 2000, which represents smaller companies in the United States. 4 different markets, 4 different economies. The term is 6 years from March 2026 to April 2032. The coupon, the return, is 8.3% per annum, paid semi-annually, meaning every 6 months, Rahul receives 4.15% on whatever he has invested. And the capital protection is 100%. Meaning no matter what happens to those 4 indices over 6 years, Rahul gets his full principal back at maturity. Now, one more feature, and this one is important, this note has something called Autocall. I will explain exactly what that means in a moment, but first let us go back to day one, the day Rahul decides to invest, because that is where the journey begins. So Rahul says yes, he wants to invest. Now what happens next is something most people never see, because it happens behind the scenes. As advisors, our job at this stage is to go to the bank, in this case Goldman Sachs, and based on Rahul's requirements, his timeline, his risk appetite, his income needs, we work with them to get the product structured and issued. And Goldman Sachs comes back with a term sheet, a document that lays out every single conditions of the note. The coupon, the term, the indices it is linked to, the autocall conditions, everything. The term sheet is essentially the contract. Once Rahul agrees to those terms, that is the note. Now, one thing I want you to clarify here, because this is a common misconception. Rahul does not walk into Goldman Sachs office and hand over his money directly. That is not how it works. Think of it this way. If I want to buy shares of Tesla, I do not go to the Tesla showroom and say, give me one share, right? I go to a trading platform, I instruct that platform to buy shares of Tesla on my behalf. Structured Notes works exactly the same way. They are financial products, and to invest in them, you need a platform, an investment platform that is authorized to hold and transact these products on your behalf. We will cover these platforms in detail in a future video. For now, just know that step one is always having the right platform in place. So Rahul has his platform, the term sheet is agreed, and now we arrive at two very important dates. The first is the strike date, the 23rd of March 2026. This is the day the starting levels of all four indices are recorded: the Swiss Market Index, the FTSE MIB, the Nikkei 225 and the Russell 2000. Whatever level each of those indices is at on that exact date, that becomes the reference point, the benchmark. Everything that happens for the next 6 years is measured against these starting levels. The second date is the issue date, the 30th of March 2026. This is the day Rahul's money formally moves. The note is live. The clock starts. So between the 23rd and the 30th of March, the levels are locked, the money moves, and Rahul is now invested. He does not need to watch the markets every day. He does not need to make any decisions. The note runs on its own terms. And the next thing he waits for is the first observation date, which brings us to stage 2. So Rahul is now invested, the note is live, and for the next few months, nothing happens. No decisions to make, no market to watch. But behind the scenes, the clock is ticking towards something very important, the first observation date. So what exactly is an observation date? Think of it as a checkpoint. On a specific date agreed in advance and written into the term sheet, the bank looks at the underlying indices and asks a very simple question. What are these markets today compared to where they were on the strike date? That answer determines everything. Whether Rahul gets paid, whether his capital is protected, and in some cases, whether the note ends early. Now, in this Goldman Sachs note, observation happen every 6 months, semi-annually, and the first observation is not at 6 months, it is at 36 months, 3 years in. I will explain why in a moment. But first, let me explain the different types of observations, because not all observation dates do the same thing. The first type is a coupon observation. On this date, the bank checks, are all four indices at or above their starting level? If yes, Rahul gets paid 4.15% for that 6-month period goes into his account. If no, no coupon is paid for that period. But this is again important. The coupon is not lost forever. It is remembered. It accumulates. And I will come back to that. The second type is a barrier observation. This is where the bank checks whether the indices have fallen below a certain level, the barrier in this note. The capital protection is 100%, meaning there is no barrier that puts Rahul's principal at risk. No matter what happens to those four indices, his full capital comes back at maturity. That is already guaranteed from day one. The third type, and this is the most interesting one, is the autocall observation. Autocall. Let me explain this word. Auto meaning automatic, call meaning the note is called back, ended. So on an autocall observation date, the bank asks one question. Are all 4 indices at or above 100% of their starting level? If yes, the note automatically ends. Rahul gets his full capital back plus every single coupon that has accumulated since day one. If no, the note continues. Rahul stays invested and we move to the next observation date. Now in this note, the first observation date is at 36 months, March 2029, 3 years after the strike date. Why not earlier? Because Goldman Sachs has structured this note to give the market time. 3 years is a reasonable window for 4 global indices to recover even from a moderate downturn. It protects Rahul from an early exit during a temporary dip. Now, what if one of those 4 indices is below its starting level on that date? Even one. The note does not autocall, it continues. Rahul stays invested and we move to the next observation date 6 months later. And here is where the snowball effect comes in. Every coupon that was not paid because the autocall did not trigger is remembered. It accumulates. So when the note eventually does autocall or reaches final maturity, all those unpaid coupons are paid out at once. This is what the term calls a snowballing coupon. The longer the note runs without autocalling, the larger the eventual payout when it does. So we move to the final stage, maturity. So we have reached the final stage, maturity. The date is 23rd of March 2032, 6 years after the strike date. This is the last checkpoint, the final observation, and whatever happens on this date, the note ends. Rahul gets his money back. The only question is how much? Now, there are 3 possibilities outcomes at maturity, and I want you to walk through each one of them because this is where a lot of people get confused. Outcome 1 is where all 4 of the indices are at or above their starting level on the final observation date. In this case, the note autocalls at maturity. Rahul receives his full capital back plus every single coupon that has accumulated over the full 6 years. That is 12 semi-annual payments of 4.15% each, 49.8% in total return, on top of his original investments over 6 years. And remember, if the note has already autocalled earlier, say at year 3 or year 4, Rahul would have received fewer coupons, but his capital would still have come back in full. The earlier the autocall, the shorter journey, but the capital protection never changes. Outcome 2 could be one or more of the 4 indices is below its starting level on the final observation date. Now, before I explain what happens in Rahul's note, I want to take 30 seconds to explain something important, because not every structure note is 100% capital protected. And I think this is a point that is really explained clearly. Some notes have what is called a barrier, say 40%. What that means is, as long as the market does not fall by more than 40% from its starting level, their capital is protected. But if it falls beyond that barrier, your capital is at risk, and the loss is typically proportional. If the market is down 50% and your barrier was 40%, you do not lose 10%, you lose 50% of your capital because the barrier has been breached. Your protection no longer applies. I want you to understand that, because when a bank presents a structure note, you need to know exactly what kind of protection you have. Is it unconditional or is it conditional on a barrier? Those are 2 very different things. Now, coming back to Rahul's note, his protection is unconditional, 100% no barrier, no conditions. So even if every single index has fallen, even if all the 4 markets are down on the final observation date, Rahul gets his full capital back, every dollar he put in. What he does not get is the coupon. No coupons are paid in this scenario. The return is zero, but the principal is intact. Now, is zero return a good outcome? No, of course not. But compared to the alternative, if Rahul had put all the same money into those 4 markets directly and all 4 had fallen, he would have lost capital. Here, he did not lose a single dollar. That is what 100% capital protection actually means in practice. Outcome 3 is the note auto-called before reaching final maturity. This is actually the most likely outcome, and the backtesting on this specific Goldman Sachs note confirms that. Out of 1,501 historical scenarios tested over 12 years, 100% of them auto-called before or at maturity, every single one. Now, past performance is not a guarantee of future results. I want to be very clear about that, but it does tell you something meaningful about how these 4 indices have historically behaved. So, to summarize the possible outcomes simply, if markets are flat or up on an observation date, Rahul gets paid potentially, exits early with full capital plus all accumulated coupons. If markets are down on observation date, throughout the full 6 years, Rahul gets its capital back with no coupon, no gain, but no loss. Those are the boundaries. Everything else falls somewhere in between. Now, before we move on, there is one more thing I want to explain. There is another type of note called barrier reverse convertible, and it works very differently from what Rahul has. In a barrier reverse convertible note, the coupon is unconditional. You get paid every single period, no matter what the market is doing. Even if the underlying asset falls 20%, 30%, your coupon still arrives. But here is the trade-off. The barrier in a barrier reverse convertible note applies to your principal at maturity. If the market has fallen beyond that barrier by the end of the term, you do not get your full capital back. You take the loss. So the income is guaranteed, but the capital is at risk. This is the opposite of Rahul's note, where the capital is guaranteed, but the coupon depends on market performance. Neither structure is better than the other. They serve different needs. One is built for capital preservation, the other is built for guaranteed income. Knowing which one you are looking at before you invest, that is the whole point. So now we come into a question that I get asked very often, and it is a very fair question. How safe is a structure note? And my answer is always the same. A structure note is as safe as 2 things. 1, the rules written in the term sheet. 2, the creditworthiness of the bank that issued it. Let me explain both. The first layer of safety is the term sheet itself. Everything we have covered today, the capital protection, the barrier, the coupon conditions, the autocall trigger, all of it is written into the term sheet. These are not verbal promises, they are contractual obligations. The bank is legally bounded by every single condition in that document. This is why I always say, read your term sheet, not the marketing brochure, not the summary slide your banker sends you, the actual term sheet, because that is the contract, that is what the bank is obligated to deliver. If the term sheet says 100% capital protection, that is a legal commitment. The second layer of safety is the creditworthiness of the issuer, and this is the part that most people overlook. Remember, when you invest in a structure note, you are lending money to the bank. You are a creditor, and like any creditor, your money is as safe as the institution that owes it to you. This is called counterparty risk, and this is real. If Goldman Sachs, for argument's sake, were to become insolvent, unable to meet its obligation, then the promise written in that term sheet may not be honored. Not because the product failed, but because the issuer failed. Now, how likely is that? Let us look at the numbers. Goldman Sachs carries a credit rating of A1 from Moody's, A+ from S&P, A+ from Fitch. What does it mean in plain English? It means these rating agencies, whose entire job is to assess the financial strength of institutions, have evaluated Goldman Sachs and placed them among the most creditworthy institutions in the world. An A plus rating means the probability of default is extremely low, not zero, but extremely low. For context, very few banks in the world carry this level of rating, and structured notes from institutions at this credit level carry a very different risk profile than notes issued by smaller, lesser known banks. This is why the issuing bank matters, not just for reputation, but because their creditworthiness is directly tied to the safety of your investment. So when someone asks me, is this structured note safe? I ask them two questions back. First, what does the term sheet say? Is the capital protection unconditional? What are the exact conditions? Second, who is the issuer? What is their credit rating? How financially strong are they? If you can answer both of those questions clearly, you have a very good picture of the risk you're taking and the risk you're not taking. Now, I want to be honest with you here, because that is the whole point in this series. No investment is completely without risk. A structured note from an A-rated institution like Goldman Sachs, structured with a principal protection feature, offers a high degree of principal preservation at maturity, though it remains subject to the credit risk of the issuer. It is very small, but it exists. And I would rather you know that and make an informed decision than not know it and be surprised later. So let us bring this all together. We followed Rahul from the day he decided to invest to the day his money moved, through every observation date, every possible outcome at maturity, and we looked at what actually makes a structured note safe or not safe. Let me leave you with the key things I want you to remember from this video. A structured note has a clear life cycle. Issuance, where the term are locked and the money moves. Observation dates, where the bank checks the market and determines whether you get paid, and maturity, where every possible outcome is already defined in the term sheet before you invest a single dollar. The autocall feature is not a risk, it is actually a benefit. It gives you the possibility of exiting early with your full capital and your accumulated coupons if the market cooperates. If they do not, the note continues and the snowball grows. Capital protection means different things in different notes. In some note, it is unconditional. In others, it depends on a barrier. Always know which one you have. And the safety of a structured note comes down to two things: the rules in the term sheet and the creditworthiness of the issuer. Both of those are knowable. Both of those are verifiable before you invest a single dollar. This is what I mean when I say structured notes are not complex. They are simply unfamiliar. Once you understand the life cycle, once you can follow the journey of your own money from day one to maturity, the term sheet stops being intimidating. It becomes a map, and a map is only useful if you know how to read it. Now, one question I have not answered yet, and I want to be upfront about that. We talked about counterparty risk today, the risk that the issuing bank itself run into trouble, but there is a broader question that many investors ask, and it is a very valid one. What if I need my money before the note matures? What happens if I want to exit early, not because the autocall triggered, but because my circumstances changed? And the second question, what about the risk of the underlying markets themselves? We talked about barriers, we talked about outcomes, but how do you actually evaluate whether the risk in a specific note is worth taking? Those two questions, early exit and risk evaluation, that is exactly what we are going to cover in the next video. If you have questions about anything we covered today, feel free to reach out, and if you found this useful, I will see you in the next one.